Hey, military real estate investors. My name is Mark Yancich, and this is Active Duty Passive Income. Today, we're going to be talking about how to not pay taxes. And I don't mean the illegal way, and I don't mean using loopholes or whatever you want to call it. I'm talking about legally avoiding taxes, not evading them, and how to do it in a way that is awesome, quite honestly. This is called, or I call it, the spouse secret weapon. But by the end of this video, you'll realize how if you are in the military and your spouse is perhaps not. I do know that there is such a thing as dual military, but for the purposes of this example, is if only one of the two adults or the spouses in a married family are in the military and the other is not, and that spouse does not have a full-time job, there is an amazing opportunity. I call it the spouse secret weapon. We'll get into the details here in a second. But before I do, if you wouldn't mind hitting the like button and subscribing, it really helps grow our channel and impact as many military families as possible on their financial freedom journey. All right, here we go. Let's dive in. So what the spouse secret weapon really is it's literally just a designation by the IRS. It's called real estate professional. And I'm not referring to real estate agents. I'm not referring to loan officers. I'm not referring to transaction coordinators or title company people. I'm referring to real estate professional as a designation given by the IRS. There's no test you have to take. There's no license you have to bear. All it means is you work so much in real estate as a real estate investor. They basically consider your income not passive anymore, but actually active, and they let you deduct your passive income losses against your ordinary income. And that is truly an absolute game changer. And here's why.
You got my attention.
Let's go over a brief overview on how depreciation and taxes work with real estate. And then I'll get into what it takes to qualify to become a real estate professional. And then I'll explain how this all comes together and makes it a completely, just absolutely amazing strategy for a lot of military families that take real estate investing very seriously. Let's talk about taxes real quick. So taxes with real estate are amazing for many, many reasons. But the biggest one is that you can take a paper loss. And what that means is it's a loss that you take on paper, like, oh, it looks like you're actually deducting against income that you're putting in your pocket, but you're not really. You're deducting against income, but there's no real expense. You're still maybe putting the cash flow into your pocket, but you're deducting against it so you don't have to pay taxes. That, again, is depreciation. And what depreciation is basically if you look at a home, a regular home, and it is a rental property. Again, specifically rental property. This cannot be your primary residence that you're living in. If it is a rental property, it is depreciated by the residential rate. So at the residential rate of depreciation, and that is 27 and a half years. I'm going to make this as simple as possible. All that means is in 27 and a half years, that rental property will go from 100% of its value to 0% of its value.
Hey, so I just wanted to clarify that point real quick. What I mean by the property value going from whatever its value is when you purchased it down to $0 over 27 and a half years, that's in the eyes of the IRS. Just to be clear, I'm not referring to its actual property value. If you bought smartly and if you're looking at it over the long term, it's probably increasing in value. It's probably appreciating, even though the IRS is consider it depreciating in value. So it's awesome because you're able to claim that loss against the income. It's truly bananas and it's awesome.
So if you really want to figure out how much you're going to depreciate against the cash flow or against the income every single year, you just take whatever the value minus the land was, divided by 27 and a half, and boom, that's what you get to deduct or depreciate. Now, the cool thing with depreciation is if you have enough of it, you can actually go into the negatives. So you can actually have a loss. Not only will you be able to count it against your income and not have to pay any taxes on your income, let me clarify that too, defer the taxes on your income because there's a caveat that I'm going to talk about at the end as well. And for an active real estate investor, you're able to take up to $25,000 in losses that'll count against you or your family's active ordinary income. So like W-2 income, which is crazy, which is awesome. If you think about that, I don't know what else you can do that's that kind of just like simple and just deduct, like slash away $25,000 from your W-2 income. For military, that's the equivalent of almost having your BAH be tax-free. That's awesome. Now, what real estate professional does, and here's why it's just absolutely incredible, is that you're able to deduct more than $25,000 $25,000 loss. You're able to go way beyond that. It's unlimited. It becomes uncapped. If you have a lot of real estate, and I guess that's kind of a caveat too, you need to really have enough rental properties or maybe multifamily complexes or mobile home parks, or you need to have enough real estate, probably several $1,000,000 of real estate, that you can depreciate enough to actually count against enough of your income and blow past that $25,000 cap to really make it worth it. But if that is a thing, if you partnered on several multifamily complexes like I am, a mobile home park, and a few single families, then this becomes a pretty big deal. I speak from personal experience, not because me and my wife do this, but because my mom is a real estate professional for my dad and their family. They are married, filing jointly, and my mom is able to claim real estate professional for the family. More on that a little bit later. So if one of the spouses is a real estate professional and the other spouse has a W-2, the real estate activity that they have gets them to claim, I don't know, maybe $150,000 in losses. This spouse that made $150,000 on their W-2 gets to now deduct all of that. It's gone. That is so powerful because, as you all know, other than your housing or living expenses, really taxes is your biggest freaking expense. And the worst thing is when you make a bunch of money and then you have to write a check away. That really hurts. That really sucks. So let's go back to real estate professional as a designation. What does it mean? What is the process to become a real estate professional? So there's 3 primary rules you need to abide by to qualify. The first and biggest one is the 750-hour rule. What this means is you need to work on real estate rental activity that you own 750 or more hours in a calendar year. 500 of that has to be material participation, and the difference between simply working on your real estate activity and materially participating is all outlined in the IRS tax code, and your CPA or enrolled agent can help you make the distinction and understand what counts as what. But either way, the important thing that's on you is you need to just keep a log, keep a spreadsheet. My mom has a spreadsheet and she just logs all her hours. Rule number 2, you need to own at least 5% of the real estate that you're claiming your real estate activity against. And if you have more than one rental property, you need to have your enrolled agent or CPA file for you to have all of that real estate considered as one group of real estate activity that you can count that 750 hours towards. But again, 5% minimum equity in the real estate that you are appreciating against and counting your real estate activity towards on your logbook. You need those 750 hours again. And then here's the third rule is you need more than 50% of your time that you spend on like professional working activity to be spent on real estate, not something else. So if you're working at McDonald's 3 hours a day, you better be working 3.5 hours a day on real estate, on your rental properties. Because what you don't want is you don't want to end up with 755 hours of real estate activity that you've logged diligently, then come to find out you actually spent 765 hours working elsewhere. That will be a problem. If you get audited, you could get hit and they could take that designation away from you and you would not be able to benefit from the real estate professional designation as you hoped to. So I'm going to wrap this up here in a second, and I'm going to explain my biggest point is how this helps military members. But before I do, I just want to go over this again. This is not a license. Real estate professional just means that you qualify based off of the 3 rules that I gave up front, the 5% rule, the 50% rule, and the 750-hour rule. If you can do that and you keep a log and you talk to your enrolled agent or CPA about it, you should be good to go. Always keep a good log because you might get audited. It's nothing to be freaking out about. It just means that you need to have your things together. You need to have diligent bookkeeping of your hours and you should be fine. It's just the IRS checking to make sure that you're doing what you're already supposed to be doing in this particular case. The last thing I wanted to just hammer home one more time is that you need to have enough real estate for this to really matter. You really need to be able to depreciate enough to where it blows past that $25,000 cap and you're able to depreciate even more and count it against your ordinary income even more. Now, as promised, how does this work with the military? And also the one big disclaimer I needed to make. The disclaimer is you could get those taxes recaptured if you ever sell the properties. You need to do 1031 exchanges. And if you want to keep deferring it down the road forever till you pass away and then they disappear, you need to do 1031 exchanges. You can talk to your real estate tax attorney, CPA, enrolled agent, whoever that knows what they're talking about to have them help you with that strategy. But just know that if you ever take depreciation against a rental property that you own, you're going to have unrecaptured tax gains that you're going to have to pay taxes on. It's going to be capped at 25%. So even if you're in a higher tax bracket, you won't have to pay any more than 25%, but you're going to have to do it. Even if you don't claim depreciation, you're still going to have to pay recapture taxes. So you might as well do it. Basically, the IRS kind of tells you to do it. This isn't like some loophole that you're getting away with. This is an actual thing. The other disclaimer is just, hey, I'm not a tax professional. I'm not a real estate agent. I'm not a loan officer. I'm not a CPA. I'm none of those things. I'm speaking from personal experience throughout this whole video. So please just bear everything I'm saying with a grain of salt and do your own due diligence and do your own research as well. But this is my experience. And like I said, my parents do this and it's awesome. And now lastly, let's wrap this up with the example of how this could work very well in a military family. If a military family has one spouse be a active duty military member, for example, and the other is not, and maybe they have a self-employed job, a part-time job, or they're unemployed or what have you, that gives them the ability to spend a lot of their time on real estate. And by a lot, really just 2 to 3 hours is what it would require on average a day throughout the year to spend on real estate and not have to worry about that 50% rule to where their other part-time job or something would compete. So if you're unemployed, you're a homemaker, you're taking care of the kids or whatever at home, it doesn't really impact you that much. You just work on your real estate and you don't have to worry about the 50% rule really, because all of your time, all your professional working hours are being spent on real estate activity. So the 50% rule becomes easy. But again, if you do work part-time, you just have to be a little bit careful. If you're the spouse that's not the one in the military and you're PCSing all the time, in certain jobs, it's kind of hard to keep that job. If you're moving every year, 2 or 3, sometimes it's just hard to keep a career going in the same pace that it would have if you didn't move all the time. So this is a great way to sometimes step in and help financially if you guys are big real estate investors, and know that not only are you helping yourself financially because you're doing the real estate investing, which is a big deal, but you're also helping your tax situation, which is basically boosting your family W-2 income because now you have the ability to deduct against it and not have to pay as much taxes as you normally would. There you go. I think that's kind of a wrap. If you guys have any questions, please post them in the comments below. If you want to check us out and all of our resources and all of our awesome education for military families on their financial freedom journey with real estate, check out activedutypassiveincome.com and check us out on Instagram at activedutypassiveincome. This is Mark Jancic. Thank you so much for watching. I will see you in the next video. See ya.